Hello everyone, welcome to RTP discussion for Jan 2026 examination of CA Intermediate, and in this video we'll be discussing advanced accounting RTP question by question, including the case scenario as well as MCQ questions. Let's begin with question number 1. There's a statutory update with regard to the change in the applicability limits. We've already put a video on that on the YouTube channel. You can watch that. There's another small change with regard to the tax audit report, but that's not much significant. Anyways, I'll read through the same and I'll ensure that I'll share a very quick video on that separately. But we're keeping this video exclusive to discussion of RTP. The first question that we have is a case scenario question. If you can see, there's a company by name Gases Limited, and they're installing 2000 kilometers long gas pipeline. And after the pipeline is installed, the chairman of the company will stand on the pipeline and then do something like that for distribution of gas from one end to the other, and they're considering this specific gas pipeline to be a qualifying asset, meaning the entire process of installation of the gas line will take substantial period. Substantial period doesn't mean 12 months. It is any period which they think is considerably good enough to be calling that asset as qualifying asset. It is only accounting standard interpretation 1 which mentions that substantial period as 12 months, and for this purpose they borrowed funds of 700 lakhs. On the borrowed funds of 700 lakhs, which are specific borrowing by the way, because they've told for this purpose. The moment they mentioned that this borrowing is made specifically for the purpose of development of this asset, so it becomes specific borrowings. We all know it, on the specific borrowings, whatever the interest is there will be added to the cost of the asset because it is a qualifying asset. And if in case any temporary interest income is earned on this borrowing cost, that will be deducted before it is added. 700 lakhs is the borrowing and interest is at subsidized rate, and has to pay interest of 70 lakhs. They haven't mentioned anything. Okay, yeah, they mentioned annually. So every year they pay 70 lakh rupees as interest on 700 lakhs. That brings down the interest rate to 10%. The company has also invested unused funds and earning income of 7 lakhs annually. So the extent to which the money is not used, it is invested elsewhere, and the company is generating passive income of 7 lakhs, but they're paying interest cost of 70 lakhs. We all know that for specific borrowing, from the date of borrowing till the date the asset is ready to be put to use, interest has to be capitalized into the cost of the asset. However, on the idle funds, if the company earns any interest, that should be deducted before capitalizing the interest into the cost of the asset. 70 lakh is the borrowing cost, 7 lakh is the interest income earned. I would have to deduct 7 lakh from 70, and only 63 lakhs of borrowing cost can be capitalized by adding it to the cost of pipeline. During the next year, company used all the funds. So the money is left idle only in the first year. So the deduction of 7 lakhs from 70 will happen in year 1. Second year, we pay 70 lakh rupees as borrowing cost, but no fund is left idle. All the fund is being utilized. So interest will not be earned. So first year, the borrowing cost to be capitalized will be 70 minus 763. But the second year interest cost to be capitalized will be 70. Then during the year, the company used all the funds and no income was earned. During year 5, so year 1, 70 lakh minus 763. Year 2 onwards, it is 70 lakh throughout. But something's happening in year 5. What's happening in year 5? Company has completed one stretch which is 100 kilometers. We've discussed a similar kind of examples where the part of the asset, when it gets ready, proportionately the capitalization has to stop. So here, because 100 kilometers of the construction is ready out of 2000 kilometers, the extent to which interest is paid on this 100 kilometers should be charged to revenue, that is P&L. Please take your calculator and then do 100 divided by 2000. What do we get when we do 100 by 2000? Into 100. 5%. 5% of the construction is complete. So 5% of the total interest expense should be charged to revenue. 95% of the interest can be capitalized and added to the cost of the asset. This is happening in year 5. First year, 70 minus 7, 63. Second year, 70. Third year, 70. Fourth year, 70. Fifth year, out of 70 lakhs, 5% will be charged to revenue, 95% will be charged to the asset. Then, which is operational between 2 points and is capable for its intended use. They are convincing us that asset is ready for its intended use as per accounting standard 10. Borrowing cost capitalization as per accounting standard 16 has to stop. Now we've read the entire case scenario, we've understood the entire case scenario. Now let's understand the answer to the question. The first question, for year 1, how much of the borrowing cost should be capitalized for the project? Year 1, specific borrowing cost, though the funds are not utilized, entire borrowing cost will be capitalized, 70 lakh. But they've earned passive interest income of 7 lakh, that should be deducted. Answer is 70 minus 7. Oops. 70 minus 7. 63 lakh. Sorry. Hey, Chino. No, it's fine. Chino, yeah, year 1. Observe, actual borrowing cost comes to be 70 lakh. From this, I will deduct the interest earned 7 lakh, 63 lakh should be capitalized. The second question that they've asked, for year 2, oh my god, if they give for year 1, 2, 3, 4, 5, 10 marks, no, they've not asked so many, they've asked for year 2. In year 2, how much should be capitalized? In year 2, there is no idle funds. All the idle funds has been already utilized. I hope you understood. So what do we do? Actual borrowing cost is 70. In the second year, there is no idly, there's only 1 day. So we will not be deducting any portion, full 70 lakhs is to be capitalized. First year, some portion is idly. On that, interest to the extent required will be not capitalized. Interest which is earned will not be capitalized. Then answer for this B is 70 lakhs. Shall we see C? For year 5, they have not asked year 3 and 4. If they would have asked, answer would have been 70 lakhs. In year 5, how much should be borrowing cost expensed? Okay. In year 5, actual borrowing cost is same 70 lakhs. But out of this, how much should be charged to the capital of the asset? 2000 lakhs is 2000 kilometers is the entire project. 100 kilometers is ready. So to the extent asset is ready, will be charged to revenue. I'll take 70 lakhs into 100 by 2000. 100 out of 2000 kilometers, which is basically your 5%. 5% of 70 lakh will be charged to revenue, which is 3 lakh 50. Balance 66 lakh 50,000 will be capitalized to the asset. They're not asking you how much will be capitalized. They're asking you how much will be expensed in the question. They're asking you how much should be expensed by charging to P&L. Answer is 3 lakh 50,000 rupees, which is option 3. Actually, it should have been option C and question number 3. That's how it will be there in the exam. But in the RTP, they've played with the number. They've kept the question number as ABC and options as 1, 2, 3. Weird. Then do we have fourth question? Yeah. For year 5, how much borrowing cost should be capitalized? This we know. 66 lakh 50. 66 lakh 50,000. Option 2 is the correct answer. Yes. By this, we have successfully completed answering question number 1, which is on Accounting Standard 16, which is a case scenario based question in our RTP Jan 2026. We'll now move forward to question number 2, which is on Accounting Standard 19, leases. The dealer in machinery, Shakti Equipments Private Limited, leased out one of its machines to Delta Tools. Delta Tools Limited is lessee who's taking the asset. Shakti Equipment Limited is the entity which is giving the asset on lease. So the lessor is Shakti Equipment, lessee is Delta Tools, and the asset is being given on what lease? 3 years operating lease. The machine was given on equal annual leasal rental. We've done a similar question in our class where we had presented the same thing in 2 ways. One formula based approach, one big table where the cost of the asset based on production units method is found by way of depreciation. And to that we add a certain percentage of profit margin what the lessor wants to earn. We'll find the total lease rental that they should charge over the entire lease period divided by number of years to identify each year's equated annual lease rental. Same question with slightly different numbers has been there. This is not a study material question, a new question, but it is there as our study material. You please do check, and if in case you are the first one to find which question is it in a study material, do let us know in the comments so that the other students will find it easy and they'll also like it. The dealer intended to earn 20% profit margin on the cost of machinery. I think in the question that we have done in class, it is 30% profit margin. Anyways, how much is the profit margin that the dealer, Shakti Equipment, the lessor wants to earn? On the cost what he has incurred, he wants to earn 20% margin. The cost of the machinery to the dealer was 3 lakh. I am Shakti Equipments Private Limited, and I am given one machine on lease to Delta Tools, operating lease. The machine costed me 3 lakh rupees. I purchased the machine for 3 lakh. The economic useful life is 5 years, and I'm expecting this as the output: 50, 60, 40, 65, 85. This is the output that I expect over the entire useful life. Do help me with this. Quickly take the total: 50 plus 60 plus 40 plus 65 plus 85. So we are giving on lease for 3 years out of the full 5 years. Useful life of the asset is 5 years. Year 1 is under lease. Year 2, it's on lease. Year 3, it's on lease. Year 4 and year 5, asset is not on lease. And the expected output is 50, 60, 40, then 65 and 85. If I take the total, I'll get 3 lakh. That exactly is the total number of units that can be manufactured over the entire useful life of the asset. And what exactly is the amount that I want to earn? My cost of the asset is 3 lakh. And number of units that I'm manufacturing is 3 lakh. So to manufacture 1 unit, basically I'm spending 1 rupee worth of machinery. I purchased the machinery for 3 lakh and I'm manufacturing 3 lakh units from this machine. So miraculously, number of units and rupees that I spent on the machine are matching. Don't get confused. It's units. And there it is 3 lakh rupees. So 3 lakh rupees is incurred on the machinery. I want to earn 20% return. If I want to earn 20% return, you think and tell me how much money should I totally charge as rental for my client. I would have to charge to the extent they are using. During the lease period, they are manufacturing 50,000 units, 60,000 units and 40,000 units, which means they're basically using 1,50,000 worth of units. 1,50,000 out of 3 lakh basically comes to be half of the asset. My assets value is 3 lakh. On 3 lakh, I want to collect 20% extra from my client. 3 lakh plus 20% comes to be 3 lakh 60. So if I give the asset on lease for entire 5 years of its useful life, I want to collect 3 lakh 60. If I collect 3 lakh 60, my asset cost is 3 lakh. I will earn 60,000 rupees as profit, which is 20% of the cost. But I am not charging this on the proportion of units. I want to charge equally. Every year I want to charge equal amount. So first I'll find if 3,60,000 is the total lease rental amount that I should charge for production of 3 lakh units, how much should I charge for 1,50,000 units? 3,60,000 into 1,50,000 divided by 3 lakh, I should charge 1,80,000 rupees as the total lease rental for 3 years of lease period. They've asked me to compute equal annual lease rental. So if you divide it by 3, you will end up getting 60,000 as the lease rental for each of the 3 years. First year I should charge 60, second year I should charge 60, third year I should charge 60 to delta. So if they give me 1,80,000 for 3 years, where 50% of the useful production life of the asset is exhausted, I have recovered 20% profit on that 1,50,000 rupees depreciation which I would have charged to my P&L. What do we have? But the question that we've done has more computations involved in this, much more than this. And then return it to Shakti Private Limited. Because it's operating lease, the asset will revert back to the lessor. The dealer recognizes revenue as per AS9. AS9, revenue recognition. We need to recognize this rental income based on time period. In year 1, the lessor has to recognize income of 60, lessee has to pay expense of 60. Whether they pay or they don't pay, on accrual system, expense has to be booked. If they pay, cash will decrease. If they don't pay, it will be recorded on accrual basis as liability. Then you are required to compute the amount of annual lease rental that will be provided with dealer provided by the dealer with 20% profit margin. Answer is option B, 60,000. That's the answer that we just computed. We're done with the second question, which is an MCQ question, which looked like a case scenario question. Now let's move on to part 2, which is descriptive questions, starting with accounting standard 2 question, valuation of inventory. A private limited company is manufacturing terry towels. Terry towel means fancy towel that you use after coming from bath. It has Marvel characters. It has Spider-Man, Iron Man, Loki, or Anna, Thor, or our Appa, or their Ur Asgard. All of these are there. Fancy terry towels, not normal white color towel that you use. It had valued its closing inventory of finished goods at realizable value. This is where the problem starts. As per accounting standard 2 paragraph 5, inventory should be valued at cost or net realizable value, whichever is less. They are fancy terry towel, no? So they were recognized it at realizable value. Realizable value would be the value if it is lesser than cost. And that too, we should not straight away take realizable value. We should compare it with the cost, tell that realizable value is less, meaning we are foreseeing the future loss by conservative approach and reducing the inventory to FMV. That is the correct accounting treatment. But what are they doing? They're recording it at NRV inclusive of profit. And export cash incentive. Oh, you understood where is this all attitude coming from? They've got one fancy forward contract. Some foreign dealer has given them a contract saying that you give all your fancy terry towels, we will buy. They've given contract. Let's say the manufacturing cost of each towel is 100 rupees. They're selling it for 1000 rupees. They got one contract to sell 1 lakh towels at 1000. So what are they doing? Because there is a contract agreement signed where the buyer is ready. This manufacturing cost is 100. Selling price is 1000. They're recording everything at 1000, including 900 rupees profit even before it is earned. Is it right? No. Firm's contract had been received and goods were packed for export. You pack it and keep it ready, but don't do show off here by recognizing profit much in advance. This is breach of conservative concept. But the ownership in these goods is not yet been transferred. Obviously, no. When will the ownership gets transferred? As per accounting standard 9, risk, reward and effective control should be transferred. Only then the ownership is transferred. Only then you can recognize your sale. Here, they've received order. They've manufactured towel. They've packed it. They've kept it. They've not sent yet. Already they're recognizing profit of 1000 rupees is the value at which they're recognizing one towel. Where the manufacturing cost is 100. So they're pre-booking how much profit? 900. Is it right? This is what we call as Tirpeshoki, recognizing the profit before being earned. So incorrect. Comment on the valuation of inventories by the company. But you can't use all these urban dictionary words in your answer. You have to write the answer with due respect. To start the answer by telling, as per accounting standard 2, inventory should be valued at cost or NRV, whichever is less. Further, as per accounting standard 9, revenue recognition. Revenue should be recognized only on the transfer of risk, reward and effective control. We've given both the points. Accounting standard 2 allows you to value the inventory at NRV if it is agricultural produce. Terry towel might be made of cotton. Cotton might come from plant. Plant growing might be agricultural, but towel is not agricultural produce. If towel is agricultural produce, from tomorrow I will sell fancy clothes and I'll say it's agricultural income and I will not pay income tax on the same. Will you leave me? Nirmala ante attuskombartare. So towel might be made out of cotton might come out of plant might be agricultural produce, but towel ultimately is not agricultural produce. If that is the case, then I'll sell masala puri tomorrow and then say it is agricultural income. Why? It has batani, it has godi, it has carrot, it has mullangi, everything. No, incorrect. So agricultural produce and mineral resources can be valued at NRV, but terry towel is not agricultural produce. So it should be valued at lower of cost and NRV. Accounting treatment followed by the entity is incorrect. Full bakwas. Wrong answer. Whatever they've done. Our answer. What you've done is wrong. You correct your mistake. If not, we will give you a qualified opinion under essay 700 or 705. That you see in your auditing RTP revision, which will be posted later, is only going to be accounts RTP revision. Come to next question. There we go. Let's continue. You are accountant of Zenith Industries Limited. This is an accounting standard 4 question. The company, you got a job before even you qualified. And sale of consumer products across India. Zenith Industries, what do they do? Other than giving employment to you as an accountant, they manufacture and sell consumer products. The company has its corporate office in Mumbai. Oh, not Bangalore. And in extensive network of stockists and distributors throughout the country. You are preparing financial statements as on 31st of March 2025. Remember, you are preparing financial statements for the year ended 31st of March 2025. You are not preparing on 31st of March 25. After 31st of March 25, for you to accumulate all the ledger data, all the journal data, to prepare trial balance, to prepare financial statements, then get the approval of the board. It will take quite some time. If any transaction happens after the year end, that is 31st March, before the board approves the financial statements, any transaction happening in the time gap, that is called as EOBD, means events occurring after balance sheet date. If any of this EOBD, if the condition is existing on the balance sheet date and the event occurring after balance sheet date gives you additional evidence, then such transaction can be considered as an adjusting transaction, or such event can be considered as an adjusting event. And though it happens after 31st March, its impact will be given back in the financial statement prepared as on 31st of March. I hope you understood the quick revision of accounting standard 4. Let's proceed. What happened? Fire accident. Sure. When did it happen? 10th April. See, our year is ending on 31st of March. Fire is breaking out on 10th of April. I don't know on 31st of March that the fire will break out. If I know on 31st of March that the fire will break out, I will put water before the fire catches. But because I don't know, there is no condition existing on balance sheet date. You cannot make provision for loss from fire that will happen in the future. No. If some astrologer on the TV predicts that there will be one earthquake happening later, you ask him to stop. No astrologer will tell prior that there will be earthquake happening after 5 years. After 5 years, when the earthquake happens, they tells that they had told 5 years ago that the earthquake will happen. Basically, all I'm trying to tell is a fire accident cannot be predicted in prior. You don't have any condition existing on the balance sheet date that such an event will happen. And major fire broke out, company's warehouse resulting in destruction of uninsured stock of 10 lakh. Some stock you had not even take insurance. You should have taken, no. No, you didn't take. No, badakali, bye. 10 lakh rupees worth of stock lost. However, the company managed to recover the value at salvaged condition, 2 lakh. That half burnt stock is there, no? Like a half burnt roti, it can also be consumed. Just need some motivation. So with motivated mindset, they sold the damaged inventory for 2 lakh rupees. So 10 lakh rupees is the cost of inventory. Because it is caught because of fire, it little damaged because of fire, they sold it for 2 lakh. They incurred loss of 8 lakh. And this 8 lakh loss is happening on 10th of April. Should we write it in the financial statements as on 31st of March 2025? The answer is no. This is not an adjusting event. Is this an event occurring after balance sheet date? Yes, this is an event occurring after balance sheet date. But is this an adjusting event? The answer is no, this is not an adjusting event. The reason is because there was no condition existing on the balance sheet date, though it did give additional information later. So let me show you the answer. The key consideration is whether the impact of loss is material. Yeah, that is the second point. Firstly, because the condition was not existing on the balance sheet date, though it happened before the financial statement approval, it is a non-adjusting event. Then we'll look at the exceptional case. If such an event which happens after the balance sheet date, though the condition is not existing on the balance sheet date, if it raises a question mark on the substratum of going concern, then it will be still considered as an adjusting event. Have they mentioned anything about the fact that it is affecting the going concern? Nothing is mentioned. So we will never assume that going concern is questioned, because that's the fundamental accounting assumption that we should always do, that entity is always a going concern. And the fire occurred on the balance sheet date and does not relate to condition existing on balance sheet date. This is a non-adjusting event. However, since the loss is material, this is an assumption that they're making, which we should not make. Not only due to uninsured stock, but also due to company's exposure fact. The uninsured portion must be disclosed in financials. Just disclosure you can do, saying that this happened, this loss is there, this is the case. You can disclose, but should you adjust it in the financial statement? Should I reduce it from my inventory? Should I rate loss in my P&L? The answer is no. Disclosure should include the nature of the event, estimated financial impact, vulnerabilities, if any. Done. First part. Now let's see the second part. What is happening in the second part? Legal claim. On 18th April 2025, a party filed a lawsuit against the company alleging that one of its advertisement is misleading. Oh my God. Could cause loss to competitors. The suit claims damages of 20 lakh. So someone filed a case on us on 18th April. 18 is a beautiful number. April is a beautiful month. So in the month of April, on 18th, if they file a case on us saying that advertisement that we gave caused loss to competitor for 20 lakh rupees, is there a condition existing on the balance sheet date? No. This is an event occurring after balance sheet date against which no condition is existing on the balance sheet date. So this is not an adjusting event. Further, if the case filed by the competitor is such that it might make my business get closed, then there is a question mark on going concern, then again it would become adjusting event. But I don't think one small case filed on us will make us wind up our business. Yeah, I have 4 murder cases on my name for students not talking in the class, not responding, not doing homework, but I'm still here teaching. So similarly, case being there will not have effect on the going concernness of the entity. So let's anyways read the answer. The lawsuit was initiated after the balance sheet date and does not provide additional evidence. That's the reason it's non-adjusting. It would have become adjusting event if it would have raised question mark on the going concern, but we are considering that not a possibility. But because it is a contingent liability, you can disclose it as a contingent liability in the footnotes of the financial statements. That's what is given in the next part. I hope everybody got it. Let's see C. What is there in C? Checks in hand and revenue recognition. Zenith Industries, the company in which you are appointed as an accountant, sells its product to stockists across all over India. In every part of the India, you have your customer and you are selling goods there. And as part of its year-end accounting on 31st of March 2025, company proposes to recognize all the checks bearing the date 31st of March 2025 or earlier received from stockists as checks in hand by reducing trade receivables. These checks are proposed to be shown under cash and cash equivalent in the balance sheet. So you have received some check from your customers and check is not encashed yet. They want to show it as a checks in hand as a separate item under the head cash and cash equivalent. Simple. If the check received is deposited into the bank, it will go to bank balance. If it is not deposited, you can show it under checks in hand category. That's right. The waiting is because the check, once it is deposited, will take a little time to get cleared. They can do this provided they've collected the checks. If the check is, for example, you are the accountant, you are Zenith Industries, I am your customer who's sitting somewhere in some corner of India. Let's say I am in some new bottom of the corner of the India in Kerala, and this company is in Mumbai. Kerala to Mumbai, there is some distance, and I am your customer. I wrote one check. I have a pen. See, I wrote one check. I signed. Check is with me. I have not given it to you yet. How can you rate it as check in hand? You should have collected it before 31st of March. Then you can rate. If you have not collected it before 31st of March, you cannot rate. Further, it's a very outdated question. This kind of questions cannot practically happen now because now people do any NEFT, RTGS, or they'll just do Phone Pay, Google Pay only. Kerala to Kashmir also possible, Phone Pay. So I've written the check. I've kept it with me. Zenith Industries accountant cannot write the journal entry. He can write the entry only when I give the check before 31st March. Beautiful point which used to be asked previously, which they've included in this RTP, very outdated yet given in your RTP question, is that you have a collection agent. One employee of Zenith Industries goes to every customer just to collect check. This used to be as a case previously where people used to go to shop and then collect cash and come. Now there are no people who are collection agents. So you have a collection agent, marketing personnel or sales agent. He will come to my shop in Kerala. I will give you money or I will give you check. He has collected it by 31st March but is not reached your Mumbai head office. So check is collected by your employee. It is like you have collected it, though it is not reached your office. So you can record it in your balance sheet as an asset under cash and cash equivalent. What if I send a check by courier? Courier person is not your employee. So the courier agent has it on 31st March. You receive the check only after 31st March. You receive the check on 3rd April, 4th April. So there is no condition existing on balance sheet date. You don't have to record it as your asset. For Zenith Industries, to record the check as their asset, they should have received the check directly before 31st March, or their agent or employee should have received it before that. They've given that. However, following two categories of checks exist. Checks collected by marketing personnel of the company. If marketing personnel of the company has collected the check before 31st March, it is as good as company has collected the check before 31st March. Second one, check is sent by courier. This is a very outdated question, but they've reconsidered it and issued it in our RTP. Let's see. Checks in hand. Checks collected by marketing personnel. These checks are physically collected by company's employees on or before 31st March. Since marketing personnel act as representative by the collection of check, then it will be recorded as like a part of our entity's cash collections. However, second case, you see, checks collected through courier, even if the checks dated 31st March or earlier, they were received by the company only after the balance sheet date. Hence, this will not be recognized as a part of our receipt. This is a non-adjusting event. So either the company directly or its employee should have collected the check before 31st of March. Then we can reduce it from our debtors asset and write that check as cash and cash equivalent. If the check is sent through courier and courier guy has it on 31st of March, we've not got our hands on the check before 31st March, then we cannot record it. It's a non-adjusting event. If it is material, we can disclose it in our financial statements. If it is immaterial, there is no disclosure also needed with regard to this item. This is the question on Accounting Standard 4, question number 4. Next up, we will see Accounting Standard 5 question, question number 5. The accountant of Beryl Limited has asked you to identify the following. They have given list of items. They want you to tell if it is change in accounting policy, if it is change in accounting estimate, if it is extraordinary item, prior period item, or ordinary item. Let's begin. The first one, non-provision of salary in previous year. Salary is an expense. Expense has to be accounted on accrual basis. That year's salary will be recorded in that year as expense, whether you pay or you don't pay. They have taken services from the employee in the previous year. They have not given him salary. They have not recorded salary expense. They have not recorded as outstanding salary also. This is a prior period item. Why? They were supposed to record the salary expense. If they don't record, they're breaching the accrual concept. They're breaching matching concept. So it will be appearing in the current year and we will pay in current year. They should have actually recorded expense last year and paid this year is okay. But they have not provided for salary. It's a prior period item. Item arising in current year because of an error or omission in previous year. Next, attachment of enterprise property. Some part of the property has been attached against a liability. We are not selling that asset to buy another asset. We are selling that asset because we have not paid some liability. I did not pay timely to my debenture holders. They are taking over my stock. Or I did not clear bank overdraft. They are taking over my investment. Something like this. So this is not in the ordinary course of business. This is not happening in order to continue the business. This is happening to disrupt the business. So this is an extraordinary item. The next one, introduction of a new pension scheme. Basically, they're putting a bait on you and making you get tempted and call it change in accounting policy, but you should not eat that bait. This is not change in accounting policy. This is a new policy adopted, so it is ordinary item. If they already have one pension scheme, from that if they shift to another pension scheme, or if they're paying pension ex gratia, or they're doing on based on some formula and they're changing it to another formula, that will be change in accounting policy. When there is no policy and you introduce a new policy, that is not change in policy, but that is introduction of new policy. To call it change in policy, there should be one policy, it should be replaced with another new policy. Then change in the reserves for obsolete inventory. So some inventory of the entity is valued at cost or NRV, whichever is less. It is absolute, meaning outdated inventory. Nobody is willing to buy. Because nobody is willing to buy 100 rupees inventory, people are willing to buy at 80. It is outdated, outstocked inventory, slow moving inventory. So I'll value it at 80, FMV being NRV being less than cost. And this NRV is 80, cost is 100. I valued at whichever is less, which is 80. Now this 80 I'm changing. They're telling change in reserves for absolute inventory, meaning that 20 rupees loss is there. No, I've created that provision. Now I'm changing the provision because I expected 100 rupees inventory to be sold at 80. Now I'm expecting it to be sold at 70. I should change the reserve provision 20. I'm making the provision into 30. That additional provision created is because of decrease in the expected realizable value. Expected realizable value is an accounting estimate. Provision created for loss is an accounting estimate. When it changes, it is called change in accounting estimate. Accounting estimate is made based on the past experience and present situation. Based on better understanding and more experience, accounting estimate will go through some change. Such changes accounting estimate is to be given prospective effect, not retrospective effect. Settlement of litigation case. Some litigation is there, we and then one more person. And I've seen and I've decided to settle. I told why to fight in court of law. You come, you take this much money, close the case. This is ordinary. This can happen day in, day out in the business. Legislation. What is ordinary item? Items which will appear in the course of the business, in furtherance of the business, or in continuation of the business. That is ordinary. Then legislative changes have long-term retrospective application. Some law is changing. Now on my products, GST was not applicable. Now suddenly they told GST is applicable at 18%. Some legislative changes. Or my income was not taxable. I'm running some specific kind of business which was exempt. Now that's become taxable at a very high rate. Something like that. Some new legislation has come, which is going to bring in long-term retrospective application impact on my business. So this is going to be an extraordinary item. This is not in the ordinary course. When such big statutory change happens, then it's going to impact my business big time. Are you getting it? Then change from cost model to revaluation model. You are following cost model of PPE. Now you are shifting to revaluation model. You will do that upward, downward revaluation, book it to revaluation reserve, or write it to P&L. This is change in accounting policy. Because it is change in policy, we would have to give retrospective effect. Remember that. Government sanctioned grant in the current year for expenses incurred in the previous accounting year. We incurred some expense. For that, government gave us the grant in the current year. When did we incur the expense? Previous year. Don't you think we should have recognized this income in the last year only? We should have recognized it last year. Because we did not recognize this grant income last year, and if we record it this year, it will become a prior period item. Government sanctioned grant in current year for expenses incurred in previous year. Yeah, it ends up becoming a prior period item if the grant was announced last year. I'm assuming that grant was announced last year. We have postponed the recognition of the grant till this year. If it was not announced last year, then I recorded this year, then it's not a prior period item. When is it a prior period item? I incurred expense last year. Grant was announced last year. but I did not record the grant income last year, but I'm recording it this year. That will become prior period item. What if I incurred the expense last year? I filed the grant certificate, a grant for claim, and grant was accepted by the government only this year. Then it should be recognized as income only in current year. Then it will be not prior period. Let's see once what is the answer that they have given. The last one. Yeah, they have given it as a prior period item. So this is slightly questionable. The assumption here is that grant was announced by the government last year only. We were supposed to recognize that income in the last year only. We have not done it last year. We have recognized it as income this year. Last year, what should have they done? They should have reduced that expense by the claim amount received, and only balance, if there is excess, should have been the expense. By this, we are done with question number 5. Let's quickly see the question number 6. There is one more question on accounting standard 5 only. Read this. Best Limited is engaged in the business of providing consultancy services. A few days back, it received a notice on GST from the department raising a demand of GST consultancy services for rupees 2,50,000. Recently, Best Limited paid the demand. In the books, payment is recorded as extraordinary expenditure. Paying tax is not an extraordinary expenditure. Paying tax is part and parcel of the business. Any activity which happens as a part of the business or in furtherance of the business or alongside of the business is ordinary. It is not extraordinary. Yeah, on the last year GST non-payment, if they file a what to say, if they send a notice and you end up paying this year, still it is ordinary. It is not even a prior period item. Did you intentionally pay less last year? Did they give demand notice last year and you did not book the expense last year and you booked it this year? Then it is prior period. If you receive demand notice this year, if you paid the amount this year, then it is not a prior period item. It is not an extraordinary item. It is not even an exceptional item. It is ordinary item. Whether the tax demand raised by the tax authority can be recognized as extraordinary item? No. The answer, it will be here only. See, no, payment of tax cannot be an extraordinary item. As per AS5, extraordinary items are incomes that arise from events which are clearly distinct from the business operations. If it is part of the business, furtherance of the business, ordinary. If it is distinct from the ordinary course, then it is extraordinary. It is not distinct. And frequency is not the only condition to call it extraordinary. We have written a very clear point in our class also. Frequency is not the sole consideration. In the instant case, providing consultancy services is the ordinary course of business. So paying GST is also the same. Done. That's it. This is with regard to question number 6. Can we now go to question number 7? Question number 7, Tala for a reason, is accounting standard 7. There's a construction contractor and he has entered into a fixed price contract of 18,000 lakhs to construct a bridge within 3 years. Very good. Construction contract gives us revenue of 18,000 lakhs and the contract period is 3 full years. The contract specifies that total contract price and includes provision for variation in work. Remember, contract revenue will include the initial contract revenue. It will include variations, incentives, claims, penalties. So they've told that it can include variations. Variation is change in the scope of the contract. With change in the scope of the contract, we can increase or decrease the contract revenue. And the contractor maintains details records. Okay, let him maintain the record. What do they want? The variation in the cost in year 2 has been approved by customer. Second year, they've added 400 lakhs extra to the revenue. Initially, agreed revenue was 18,000. Second year, it became 18,000 plus 400. The customer asked for some change in the construction. The contractor agreed at a cost of 400 lakhs being charged extra. What do we have after this? Then they're asking us to identify the revenue to be recognized in statement of profit or loss, expense to be recognized in statement of profit or loss, contract cost to complete the remaining work, profit and loss to be recognized each year. We can start. Let's start. Initial amount, contract revenue 18,000. Cost incurred 4186, estimated profit 1900. So take the contract revenue 18,000. From that you deduct 1900, you will get the total cost. They have not given the cost to be incurred. Usually they'll give cost to be incurred. In this they've given sale price and they've given profit. From the sale price, if I deduct profit, I'll get cost. Take 18,000, deduct 1900. 16,100 is the total cost. How much is incurred? 4,186. 4,186 divided by 16,100 if you do, you'll get percentage of completion. Let me show. Contract revenue as given in the question. There is no variation in year 1. It will remain 18,000. I'll deduct the profit that they've told for the whole contract 1,900. Total contract cost becomes 16,100. The extent to which the cost is incurred is 4,186. If I do 4,186 divided by 16,100, I'll get percentage completion as 26. So based on percentage completion method, I should book 20% of the contract revenue as my income. Total contract revenue is 18,000. I'll do 18,000 into 26%, which is 4,680 as my revenue till date. And I'll also book my contract expense to the extent it is incurred. Contract expense, we know it, 4,168. Any revenue is already recognized? No. What is the revenue to be recognized in year 1? 4,680. How much is the contract cost incurred in year 1? 4,186. How much is the contract cost incurred till date? 4,186. Any already recognized? No, 0, because this is year 1. To be recognized in year 1, 4,186. Revenue is 4,680. Cost is 4,186. Profit is 4,680 minus 4,186. What do we get? 4,494. For year 2, contract revenue is changing. 18,000 plus 400. 18,000 plus 400, which is 18,400. Then estimated profit from the contract is 2,000. They're expecting profit of 2,000 from the contract. So can I say the total cost will become 16,400? In 16,400, how much is incurred? 12,336, but it has a star. We'll read what does the star say. Includes 200 lakhs of standard material stored at the site to be used for completion in year 3. So 200 lakhs worth of material is issued but not utilized. So out of 12,336, I should deduct 200. So I'll take 12,336 minus 200, which will make it 12,136 as total cost incurred till the end of year 2. Now take 12,136 in the numerator and divide it by 16,400, which is total cost. We'll get the percentage of completion. 72%? 74. This is a very familiar question. 26, 74 and 100. I think we have the exact same question with exact same numbers in our material. Or might be slightly different numbers, but I very strongly believe. Also check this and let's see who's the first one to comment in the comment and tell us which question is it from our material. It's a contest. You can buy yourself a chocolate and say that I gifted it to you. How much is the contract revenue in total? Contract revenue in total to be recognized is 18,400 for 100%. Because 74% of it is complete, I can book 13,616 not in year 2 till the end of year 2. In this, already 4,680 is recognized in year 1. So second year contract revenue is 13,616 minus 4,680. 8,936. Similarly, contract cost incurred till date will be 12,136. Out of 12,136, already 4,186 as recognized as expense in the previous year. If I deduct, I will get 7,950 as contract expense for year 2. Contract revenue in year 2 is 8,936. Contract expense in year 2 is 7,950. If you can do 8,936 minus 7,950, 986 will become your contract profit for year 2. Got this? Let's go to year 3. Year 3, again, revenue is same, 18,000 plus 400. 18,400. Profit that they're expecting in total contract is 2,000. If I deduct 2,000, I'll get 16,400 as the total contract cost. That's not changing. They're telling 16,200 is the contract cost incurred up to date. They've given 2 stars. Excludes 200 lakhs of standard material which was bought in year 2. This is supposed to be included, no? We will add it. Actually, it should have been already included that we should not add, but we are adding. And mentally, you should also know, no, total cost of the contract is 16,400. If you read 16,200 here, it will become less than 100% complete. How can it be less than 100% complete? It can't be. Now I am 100% sure this question is there. I remember this. Full nostalgia aagta hai. Yeah. Do you remember which question? Nobody knows. Okay, fine. 16,400. Can I say the contract is 100% complete? That is 16,200 plus 200. And 100% of the contract is complete. How did you get it? 16,400 by 16,400. That is 1 multiplied by 100. I should recognize 100% of 18,400 as my revenue, which is 18,400. already recognized is 13,616. That is 4,680 in year 1, 8,936 in year 2. If you want, you can write separately or directly take this 13,616. If you deduct 13,616 from 18,400, you will get the revenue to be recognized in year 3, which is 4,784. Total expense incurred till the end of year 3 is 16,400. In that, how much is already recognized? It is 12,136, or you can take it as 4,186 plus 7,950. From 16,400, if you deduct 12,136, you will get the expense to be recognized in year 3, which is 4,264. Third year revenue 4,784. Third year expense 4,264. If you write 4,784 and deduct 4,264 from the same, you will get contract profit of 520 rupees. This is the answer. 494 first year profit, 986 second year profit, 520 third year profit. That's what they've asked. They asked cost incurred, percentage completion, how much revenue to book, how much profit to book. Full. Done. We're done with accounting standard 7 question number 7 from the material. Let's go to the next question. Next question is question number 9. Sorry, question number 8. Accounting standard 9, revenue recognition. Class Limited is a well-established real estate developer and builder engaged in residential and commercial products, full chains, rings and everything. White color shirt, mobile phone here with camera popping out, iPhone 17 Pro Max. The financial year 2025, company purchased a unit of land situated in prime location. Rich people know they buy. For what price did they buy? 225 crore. Intending to develop a high-end residential complex within a few months from the acquisition. Due to strategic decision to reallocate resources to another product and take advantage of favorable market conditions, Class Limited sold the land at a price of 360. Oh, they bought land at 225 crore. They wanted to construct the building and sell. But to take up another project which is more favorable, they sold the land at 360. The company maintained proper books and all legal formalities are done. What should we do? Advise Class Limited on recognition of revenue from the transaction. Okay, when should we recognize the revenue? Revenue should be recognized on transfer of risk, reward and effective control. Let's see what is the answer that they've given. On the date when it is sold. AS9 revenue recognition stated that revenue should be recognized when there is reasonable certainty of collection arising from the ordinary activities. Whenever we have sold, if we have a reasonable certainty that we'll receive the money, we should recognize. Is arising out of ordinary activities. Revenue should be recognized when there is a reasonable certainty to collect. Will not wait for the actual date of sale. And this will not be treated as extraordinary activity because we are buyer and developer. Buying the land, selling the land, it's not an extraordinary item. It is part and parcel of our daily operations. To others, it might be extraordinary. For us, extraordinary things, what is extraordinary for others is ordinary for us. Because we deal with high value items. We buy and sell lands like how people buy and sell peanuts. And it can be considered extraordinary based on size, incidence and nature. It can be considered exceptional. Ordinary items can be considered as exceptional based on size, incidence and nature. That's one thing they've told. And hence 360 crores realized from the sale of land shall be recognized as revenue when the sale is completed. That's what it told. Conclusion. It should be recognized as sale when the sale is completed. That's it. That's the end of question number 8 on accounting standard 9. Let's see the next one. Question number 9 on accounting standard 10, property, plant and equipment. Same company in which you are accountant, Zenith Limited, a medium-sized manufacturing company engaged in production of precision industrial components, has provided the following details regarding fixed assets. You are required to calculate depreciation for each asset for the year ended 31st of March 2025. Provisions of AS10 to be applied properly. Will apply. Machinery was purchased on 1st April 2020. Hey, remember, for which year are we computing depreciation? 31st of March 25 means year 24-25. Year 2024-25, we are computing depreciation. Then, hey, are you sleeping when you're watching this video? Don't sleep. AS10 is an important standard. A lot of standards are based on this. Machinery was purchased for 10 lakh in 2020. Useful life is estimated to be 5 years. Residual value is 10 lakh. Take 10 lakh in the calculator. Deduct 10 lakh from the same. You got 0. Now you are awake. Divide it by 5. If you are dividing it by 5, then you are doing a mistake. So the depreciation is 0. Why? You bought the machinery for 10 lakh. At the end of 5 years, you are able to sell it for 10 lakh. So the value is not depreciated only. You people will depreciate your 5 years of life by sitting and then scrolling phone and not studying. But unlike that, this machinery value is not at all depreciating. I hope you are understanding what I'm telling. So the cost of the cost of the machinery 10 lakh. Useful life 5 years. Residual value 10 lakh. 10 lakh minus 10 lakh divided by 5 is 0. Depreciation is 0. Which year? First year, second year, third year, fourth year or fifth year? All 5 years 0 depreciation. All 5 years. How come? How is this possible? How is it that machinery you bought it for 10 lakh, you're able to sell it for 10 lakh? Maybe this machinery's cost is 1 crore. Maybe government has given it to us at a concessional price of 10 lakh. Or maybe we bought it at 1 crore, we received government grant of 90 lakh. We have reduced the cost of the asset to the extent of grant received to show it at nominal value, which if we do, we will not charge depreciation. Might be that the case. Or you have a very unique case where you kept knife on the neck of the supplier and told, give it to me for 10 lakh. I mean, you can sell the asset after 5 years also at 10 lakh. That's another case, but we are not talking about undue influence and coercion because this is not CA Foundation Contract Act revision, which will also be there on this YouTube channel, which you can watch. This is CA Intermediate Advanced Accounting RTP discussion. Next, the company owns a piece of land, small piece of land, acquired for 50 lakhs. For 50 lakhs, we'll get small piece only, which is held for use in the factory operations. Land is not depreciable asset. That is the reason value of the land is appreciating every year. 50 lakh is the cost. Useful life, indefinite. You will die, but the land will be there. After you die, you will be buried in the same land. Still the value of the land will not decrease. So, indefinite useful life. Residual value annodirodilla. So, we will do 50 divided by infinity. 50 lakh minus scrap value 0 divided by infinity. Do it. 50 lakh divided by infinity. You can't do it in the calculator. Depreciation will not come. Such a beautiful question. They've given 4 assets. In the 2 assets, depreciation is only not there. Let's see next one. They constructed a machine. Oh, self-constructed machine for its own use. You only constructed one machine for your own use at the total cost of 5 lakh. The construction was completed on 1st of April 24. We are computing depreciation for 31st of March 25. So only 1 year is over. The useful life is 10 years. However, the company did not commence the official use till 31st March. You don't use does not mean that it will not be depreciated. The moment the asset is ready, whether you use it or you don't use it, depreciation will keep happening. Your intelligent skill time, whether you use it or you don't use it, depreciation is happening. You are growing old every year. Yeah, pass very soon so that before you become 30, you become chartered accountant. Machinery was constructed for 5 lakh. Useful life 10 years. They have not used it, but still 5 lakh minus 0. Scrap value is not given. So if nothing is mentioned, it means that you are scrap value is 0. So divided by 10. Can I say 50,000 as depreciation? That's the answer for this question. Scrap value not given. Yeah. Then another machine was purchased on 1st of April 2022. This was not purchased recently. It was purchased few years ago. 50,000 having useful life of 5 years. Residual value is nil. Subsequently on 1st of April 2024, company decided the machine would not be used for, would now be used only for 2 more years. Once again, take 50,000, scrap value is not given, 0 divided by 5. 10,000 is per year depreciation. We purchased it in 22 April. 22, 23, 23, 24. 2 years asset is already depreciated. 10,000 per year. 2 years, 20. From 50, you deduct 20. 30 is the carrying amount as on 1st of April 24. They're asking depreciation for 31st of March 25. So that 30 has to be depreciated. They're telling only 2 more years. 30 should have been actually depreciated 10, 10, 10, 3 years, no? But they're telling remaining useful life is only 2. So 30 divided by 2. 15,000 is depreciation. I'll explain. Aram se have a look. You bought the asset for 50,000. You have depreciated it over 5 years for 2 years. So depreciation is 50,000 minus 0 into 2 divided by 5, 20. From 50, if we deduct 20,000 depreciation, the asset has been now held at book value is 30. They're telling the remaining useful life is revised. Estimate is revised to 2. This change is there, no, in useful life. That is change in accounting estimate. So this has to be given prospective effect. First 2 years, whatever is over. From third year, we change depreciation. We don't go back to first year and then say, no, that should not be divided by 5. That should be divided by 4. First year depreciation is not 10,000. We won't change it. First year, second year depreciation 10, 10, done. Now 30,000 should have been depreciated based on the initial estimate for 3 years as 10, 10, 10. Now I'll do it over 2 years. That is making it 15. I'll do 30 divided by 2. 15,000 is the answer. I've also mentioned a note here. Depreciation for machine should be started when the asset is ready to be put to use and not from when it is actually put to use. So that fact that it is not been put to use in that machine case is not important or not significant, not considered in the answer at any point. This is the answer on accounting standard 10 question, which is question number 9. We'll now move to accounting standard 12 question, which is question number 10. Medivale Hospitals Limited. I don't know if it is a really good hospital, but it's a hospital which is reputed for healthcare company operating chain multi-speciality hospital. Multi-speciality means whatever problem you have, you can go. They have multiple specialists for multiple organs will be treated. Yeah, for all the diseases. And they have it across India. Nice. It had acquired 40 units of Doppler scan machines. I don't know what scanning will they do with that machine. I'm a commerce student, but it does some scanning. Inside, whatever is there will be shown outside in that scanning report. And it is not there in India. They got this from USA. Okay. At a cost of $165,100. Ondondu $165,100. $165,100 per machine. They bought it not now, 22-23, right out of COVID, prevailing at an exchange rate of 50 rupees per dollar. This is false. On that year, it was not 50 rupees. 50 rupees was there when somewhere Manmohan Singh uncle was the prime minister. But okay, we are not questioning the data in the question. We'll take it that way. Please take your calculator, do 165,100 into 50. I would say cost of asset in dollars is 66 lakh 4,000. Oh, wait, how did we get that? We bought 40 units. Each unit is 165,100. They've told we bought how many units? 40 units. One unit 165,100. 40 units is 66 lakh $4,000. And exchange rate, each dollar is 50 rupees. So do 66 lakh $4,000 into 50 rupees. Cost of the asset in Indian rupees will be how much? 33 is they're not divided by 5 zeros. Basically, I'm writing it in lakhs. So if you eliminate 5 zeros, you get 3,302. If you write so many zeros, it will be difficult to complete the answer. Will end up getting 0 only. Somewhere if you do one mistake. So better to write in lakhs. So I've written it as 3,302 lakhs is the cost incurred for purchase. What do we have after that? The acquisition was partly financed by government grant amounting to 5 crores. Government told you are doing a good job. I will give you 5 crore rupees. Take it. 5 crore. Each crore is how many lakhs? 10 lakhs. 1 crore is 100 lakhs. 5 crores is 500 lakhs. So I will deduct the government grant. Shabash. Keep thinking like that only. Country needs people like you. 500 lakhs government grant. I will deduct. Then, which was sanctioned specifically for the purchase of these machines under a healthcare modernization scheme. The grant was sanctioned with a specific condition that in the event of change in the management or ownership, the grant should be refunded. If the ownership or the management changes, the grant should be given back to government. Change in the ownership and control of company, not change in the ownership and control of government. I hope you understood. Then in April 2025, 51% of the company's shareholding was acquired by overseas investor. Damar. When? April 2025. 51% was acquired by somebody else. So they've breached the condition. They have to refund the grant. When? 2025. When did they buy? 22-23. 22-23, 23-24, you will do. And in 2025, April, beginning only. 24-25 also will do. 22-23, 23-24, 24-25. 3 years you will use. 4th year, beginning only, refund. Why? Because there is change in management. The expected useful life of the machinery is 5 years. So 3 years will provide depreciation under SLM basis. And depreciation is to be provided at 20. So straight away 20% if you put, it's done. There is bank charges USD 4,000. For the entire import transaction, we paid $4,000 bank charges. This is directly attributable cost incurred to make this sale happen. $1 is 50 rupees. $4,000 is how much? $4,000 into rupees 50 per dollar. 2 lakh, I'll write it as 2. So 2 is bank charges. Then we also have sea freight, 7,500 per unit. We can't put that machine in the ocean and then say you swim and come to India. We have to bring it through a ship. For that, we need to pay freight, sea freight, 7,500 per unit. They've given in rupees. Don't multiply by 50 again. Take 7,500 rupees, what is incurred per unit, multiply that with how many scanners? 40. 7,500 per scanner into 40 scanners. 3 lakh, I've written 3. Then anything else? You are further required that the company has, further informed that company has not maintained capital reserve or deferred income account. Basically, they have two options whenever they receive government grant. One, capital reduction approach, where the entire grant amount is reduced from the cost of the asset. Second approach, the grant can be recorded in DGG, deferred government grant. There is no looking back once you account for capital reduction approach and deduct the entire government grant from the cost of the asset. So because they are not maintaining deferred government grant, we will reduce the entire grant of 500 lakh from the cost of the asset here. Anything else that they've given here? You are required to advise the accounting treatment in the books of medieval hospitals as a result of return of government grant. In 22-23, we will take the total of the cost, deduct the government grant, identify the revised cost of the asset, depreciate it at 20% SLM for 22-23, 23-24, 24-25. In 2025, April 1st, refund the entire grant amount that is been previously deducted from the cost of the asset. That way, we will increase the cost of the asset. Let's see this. 3,302 plus 2 plus 3, 3,305, 4 plus 3, 7. Minus 500 government grant, cost of PPE will be 2,807. This has to be depreciated at 20% for 3 years. What are the 3 years? 22, 23, 23, 24, 24, 25. When they told financial year 22, 23, I'm assuming beginning. 3 years. Please do 20% for 3 years. I've just mentioned the years so that later in the comments you won't ask this doubt. If you have any other doubts, please do post it in the comments. I will reply when I see them. Yeah. What do we get? 1,684 point. So then after we do this, what is the carrying amount that we get? 2,807 minus 1,684. 1,222.8 is the carrying amount of the asset on 1st of April. Because we do refund of government grant, I will add back government grant of 500, increasing the cost of the asset back to 1,622.8. Government could have been little kind to us. They would have told, okay, in 500, you keep 400, you give me 100, or you keep 300, you give me 200. No, government was not kind in this case. Government asked for full refund of full 500 lakhs, which is 5 crore rupees, what they had given as grant, forgetting the good that we have done in the last 3 years to a lot of patients whom we've sent to God. Can't help. Added back entire 500 lakhs. This is the answer to question number 10, which is on accounting standard 12, government grant. Let's now begin question number 11, which is on accounting standard 13, investment accounting. Mr. Rohan acquired 200 equity shares of Zeta Technologies Limited on a cumulative right basis. What do you mean by cumulative right basis? Before Mr. Rohan bought the shares, company has announced right issue. After the company announced right issue, before the company actually issues right, this guy bought the shares. So whenever he bought the shares, no, the shares are already pregnant. They are about to give birth to rights immediately. But he bought it after the announcement, before the issue of rights. So he's bought it at a price which is slightly higher than the market price. So on the sale of rights, if he does, after he's been allotted rights, if he sells, that consideration that he gets, usually by default, sale of right consideration should be credited to P&L account as per accounting standard 13. But in this case, the revenue that you get on the sale of the rights can be adjusted against the cost of the investments. To the extent investments value will go down, because the investments are to be valued at cost or NRV, cost or fair market value, whichever is less. We've done about 2 AQs on this, and we've done about One question in the study material we've done, and we've done 3 AQs on this. 14, 15, 16 if I'm not wrong. Yeah, just do check once. And what is the rate of rights? 1:1. And price is 214. Okay, Mr. Rohan, however, decided not to subscribe. I know this. That's what this guy would have done. And he sold it for 24,000. After the right issue became X rights, the market value of the existing company fell to 120. Market value of the shares was how much? 1,40,000. The purchase price is 1,40,000. That is cost. What is the fair market value? 120. Investments which are bought at 1,40,000 rupees, which is cost, is now valued, that is fair market value is 1,20,000. When you value the investments at the end of there, you write cost or FME, whichever is less. Cost 140, FME 120, loss of 20 will be charged to P&L. That will be adjusted against this 24,000. 24,000 sale of right entitlements consideration what we got. In the 20,000 will be adjusted against the cost. Only 4,000 will be charged to P&L as profit. 24,000 sale of rights value what I got. 20,000 will be used to reduce the cost of investments. 4,000 will be charged to P&L. Have a look. Purchase price 1,40,000. X-rate price 1,20,000. Case 13, accounting for investments. When investments are when bought on cumulative rate basis and X-rate price is lesser than cost, then when we do cost or FMV, whichever is less, investments will be valued at FMV, and that will result in loss of 20. That loss should not go to P&L, because basically we write the sale of right consideration in P&L. Here the sale of right consideration before transfer to P&L should be adjusted against the cost to the extent there is loss. So I will take 20,000 and then deduct it from my cost of investments, making it 120. But out of 24,000 sale of right consideration, 20 is adjusted against cost, 4,000 will be taken to profit and loss account. This, my friends, is question number 11 on accounting standard 13, investment accounting. Next, let's proceed to question number 16, borrowing cost. They have given a cute, sweet theory question. Can interest be included in cost of inventory? Is inventory an asset? Yes. Is inventory a qualifying asset? Yes. Then you can add the interest. Is interest actual? Interest cannot be notional. Asset has to be qualifying asset. If inventory is a qualifying asset, which means it has taken substantial period of time for it to be set up, then then it becomes a qualifying asset. Then the interest can be capitalized if interest is actual. There is no, what do you say, separate treatment for PP and separate treatment for inventory. Asset adre saku. Imele qualifying asset check ಮಾಡಬೇಕು. Let's see the answer for 12th one. If it is asset, that's sufficient. It need not be PPE. As per paragraph 6 of A16 states, borrowing cost can be directly attributable to acquisition, construction, and production of qualifying asset, should be capitalized. Paragraph 3 of A16 defines qualifying asset as an asset that necessarily takes substantial period of time for its intended use or sale. Further, inventories that require substantial period of time to bring in for its saleable condition are specifically included as an example under qualifying asset. So we can take it. And qualifying asset means asset that takes substantial period of time. This is not mentioned as to what is the period in accounting standard 16, but accounting standard interpretation 1 states that period of time refers to a period of 12 months. See, 12 months. More than 12 months. By this, we successfully complete accounting standard 16 question. Couple of more paragraphs are there. You can read it if you want. I will take you to accounting standard 13. Sorry, question number. Let's now do question number 13, which deals with accounting standard 17, segment reporting. Sorry if my tongue is going and all, because I've been taking long class morning, about 6.5 hours of class is over, and over that we're recording this RTP. Sorry. Once again, we'll try again. We're now solving question number 13, which is on accounting standard 17, segment reporting. Garnet Limited has 4 operating segments that has total revenue, internal, external, both has been given. The assets are also given. How many reportable segments does Garnet Limited have as per the revenue and assets criteria in AS17? A segment, whether it is geographical segment or it is a business segment, is reportable if turnover, as in sales, result, profit or loss, asset is greater than or equal to 10% in total, or by way of management discretion. Here they have given internal sales, external sales. We don't care internal, external. We need total sales. Write the same data for each product segment, that is fan, light, lamp, printer. Take total of, no, don't add sales and assets, external internal sales together, find total sales, then find the percentage. If it is 10% or more, reportable. For assets also 10% or more, reportable. Once you identify reportable segments based on 10% criteria for sales and assets, top there, check whether external sales from the reportable segments, is it contributing to 75% of the total external sales. If external sales from the reportable segments is contributing to 75% of the total reportable sales, total external sales, good. Those are the only 2-3 segments which are reportable. If it doesn't come to 75%, then further additional segments have to be identified as reportable, such that the total external reportable revenue should come to 75%. Let's check. Help me with the data given in the question. I'll do it horizontal. I'll not do it vertical because I need more space here. Sales, 3,200, 200, 0, 1,100, 4,500. Okay. I'll write the data, whatever they've given, internal and external, and just take a total of the same. Horizontal total is given. Now we'll do vertical total. Vertical total, fans total sales is not given. Fans total sales is 14,100, light 1,600, lamp 1,500, printer 1,300. Total of total sales is 18,500. Now identify percentage. 14,100 by 18,500. 76%. 1,600 by 18,500. Yo, who's scrolling? Open your book, open your calculator, compute it. Don't just watch me tell the numbers. Take your calculator out. Get up from your bed. 1,600 by 18,500. All of you are watching it at home, sitting on the bed, sofa, TV. Get back to your study table. Take the calculator. Do 1,500 by 18,500. 1,300 by 18,500. 7%. Did you get the percentages? And assets, data is given already. 23,700, 13,200, 4,200, 3,400 and 44,500 is the total. I'll write the data that they've given. Now, at least this you do it with me. Yeah, if you do well with the calculator with good precision, God is watching you. God sees that you're putting in effort in solving each RTP. God will say, this is a good kid. This kid should pass the exam. And God will tell ICA, please make this kid pass. He's a good boy, good girl. I've been watching. And if you're wasting time, God is watching. God will tell, I will make you cry one day when you don't have handkerchief. 23,700 by 44,500. 13,200 by 44,500. 30%. 4,200 by 44,500. 9%. 3,400 by 44,500. 8%. Now we can identify reportable segment. Fan, 76% of the revenue. Reportable, not reportable. Reportable. People who are not studying are all buying fan, stool, rope. I don't know why. This is a reportable segment. Reason is revenue. Light will be kept at the head. 9%. Assets are there enough. So it is also reportable segment based on not revenue criteria, based on asset criteria. Lamp. Actually lamp is kept, not light. But anyways, lamp is not reportable. Why? 8%, 9%, not sufficient. How about printer? 7%, 8%. Actually, people write letter. Okay, some people type and take printout and keep before using fan. Anyways, 7% and 8% not reportable. I hope you understood. We have a quick check to make. What is the quick check that we should make? Which segments are reportable? Fan and light. Take fan and lights external sales. 10,900 plus 1,400. 12,000? Take 14,000 in the denominator. 12,300 by 14,000. 0.8. Multiply that by 100. 80%. So can I say fan and light together contribute to 80% of our total external revenue? 87%. May you get 87 marks in your advanced accounting paper. Remaining 13 marks? It's okay, sir. Okay, 87 is a good score. In the very next attempt when you're writing only. Okay, 10,900 plus 1,400 divided by 14,000, you got 87. 87% of the total external revenue contribution is from reportable segments. There is no need to identify any other segment as reportable segment. Include that as a part of your answer. Based on sales turnover, fan. Based on assets, fan and light. And external revenue contribution, 10,900 plus 1,400 divided by 14,000. They contribute to 87 point, you forgot, 87.86% of the total revenue, because it contributes to more than 75%. It is not a reportable, sorry, there is no need to identify any other segment as a reportable segment. This is the answer to question number 13, which is on accounting standard 17. Let's continue with accounting standard 18 based question. This is question number 14 from our RTP. What does this question say? Mr. Rajiv is KMP, key management personnel of Rajavardhan Limited. It's a company. And whenever you are a person who's key management personnel, you have significant influence on the company. So you are a related party. And not just you, your relatives are also related parties. Your relatives as in mother, father, brother, sister, wife, spouse or husband, children's. All of them are considered to be relatives, related parties to the company. And the company gave a check. So basically, Mr. Rajiv, the KMP, took a check of 70,000 towards reimbursement of expenses. So what Mr. Rajiv has done is, he's made some payments on behalf of the company. Company should have paid it. He has paid it. Because he has paid on behalf of the company, he will take that money from the company. Is Mr. Rajiv a related party? Yes. Is this a transaction? Yes. But is there a separate disclosure of this needed? No. It is an expense which should have been paid by the company. On behalf of the company, he has paid. You've been asked, you are required to guide whether the above transactions is covered under AS 18. Have a look. Question number 14. As per accounting standard 18, related parties, entities over which KMP and its relatives are able to exercise significant influence are related parties. So Mr. Rajiv along with his relatives are related parties. Thus, as per the facts, related party of the company, KMP is a related party of the company. But reimbursement is not in the nature of remuneration, so not to be disclosed in the financial reporting. Is this supposed to be disclosed separately? No. Is he a related party? Yes. And is his relatives also related party? Yes. Reason? Because he can influence significantly. He can have significant influence over the company. We're done with the 14th question, which is on accounting standard 18. Let's now move to accounting standard 19, leases question. Accounting standard 19 leases, question number 15. On 1st of April 2024, Mansi Limited sold a plant for rupees 8,52,800. The carrying amount of the plant as on that date is 1,80,000. So 1,80,000 is the book value of the plant, and Mansi sold this plant for 8,52,800. Huge profit they made on this particular sale. And the sale was part of a package under which Akash Limited leased the asset to Mansi for 8 years term. So I am Mansi. I sold my asset to Akash. Book value of the plant in my books is 1,80,000. I sold it to 8,52,800. And he gave the asset back to me on lease. So this is sale come lease back. Sale followed by sale and lease back. So I've sold the asset to Akash. Akash gave it back to me on lease. Now we need to check whether this is the lease that follows. Is it financial lease or is it operating lease? Because based on that, we will check everything else. Because before sale, I was the owner. I am Mansi. And after I sell it to Akash, Akash becomes the owner. If Akash gives it back to me on finance lease, Akash is not the real owner, because in finance lease, risk reward effective control is transferred to me, and by substratum, by the logic that risk reward and effective control is transferred back to me, the substance of the transaction tells that I am the owner. So before sale, Mansi is the owner. After sale, if it is finance lease, again Mansi is the owner. That is finance lease. If it is operating lease, I have sold it to him. He becomes the owner. He will give it to me on operating lease. Are you getting it? So if it is operating lease, the accounting treatment is different. If it is finance lease, the treatment is very different. And if it is operating lease, we would have to defer the income. If there is any profit, we should not take it completely in 1 year. It should be transferred over the operating lease period. I hope you understood. Done. How much is the profit? First of all, find the profit. 8,52,800 minus 1,80,000. 6 lakh 72,800 is the profit on sale of this asset. The economic life of the asset is 8 years. The minimum lease rental expected is 1,60,000. Basically, they're not telling us. It's okay. They're not telling whether it is operating or financing. They want us to find. Do you remember 5 conditions based on which we'll decide whether the lease that follows is operating lease or finance lease? Number 1, if present value of MLP, minimum lease payment, substantially covers the cost of the asset, it is finance lease. Number 2, if the lease period substantially covers the useful life of the asset, then it is finance lease. Number 3, if substantial risk and reward of the asset is transferred by the lessor to lessee, it is finance lease. Number 3, if the lessee has the right to buy the asset at the end of the lease, it is finance lease. Number 5, lessee gets to buy the asset at the end of the lease period at a price much lesser than the market price, much below the fair value, then it is finance lease. And they've not given direct information to us here. What is the fair value of the asset? No, they have not told that. Yeah, we'll see. We'll check comparison. Fair value of the asset, that is sale price, is 8,52,800. Once I sell it to him, that is considered to be the fair value. At what price is he giving it back on the lease? At what price is he giving it back on the lease? 1,60,000 payable. How many years? Lease period is 8 years. For 8 years, he is giving it at 1,60,000. We'll identify the present value of the future lease payments. For that, I need to do one working note. Let's do one cute working note identifying the present value of MLP. MLP lease payment is 1,60,000 multiplied by 1 by 1.08 to the power, 1.1 to the power 8. 1 divided by 1.1 is equal to, you do it 8 times. We have to do GT at the end because it is annuity factor. 1 divided by 1.1 is equal to first year, is equal to second year, is equal to third year, fourth year, fifth year, sixth year, seventh year, eighth year. Then click on GT to get the total. 5.335 is present value annuity factor. Do 1,60,000 into 5.335. 8,53,600 is the value. Those of you who are finding this difficult, you have skipped time value of money in foundation, you skip time value of money in FM. Please do that. And then look at this. 8,53,600. So 8,53,600 is the present value of MLP. Substantially allied. It's covering full of fair value of the asset and much beyond. Akash Limited, when they give the asset back to me on lease, I am paying him lease installment. All of it together will come to more than 8,52,800. And the remaining useful life of the asset is 8 years. The lease period is 8 years. So it's covering substantially, not substantially, it's covering the entire remaining useful life. This is a very evident proof that the lease that it follows is finance lease. What is the lease that it follows? Present value of MLP covers fair value of the asset and the lease term covers entire useful life. It is what lease? Finance lease. I've sold the asset and I've taken it back on what lease? Finance lease. So the incremental borrowing interest rate is determined at 10%. That's basically the rate that they're telling us. Calculate the net effect on statement of profit or loss. See the answer that they've given here. What have they told here? For the calculation of net effect of statement of profit or loss, it should be judged whether the lease is operating lease or finance lease. The lease term is for 8 years, which covers the entire economic useful life at the time of inception. 1 point in favor of finance lease. At the time of inception, the lease payments 853,600. That is what we did know, 1,60,000 into 5.335, which substantially covers the entire sale price of 8,52,800. Basically, they've also concluded that it is finance lease. Then comes the answer. As per para 48, if the sale and lease back transaction is a finance lease, the profit that we computed here, 6 lakh, we did not compute the profit, sorry. Carrying amount of the asset is 1,80,000. Sale price is 8,52,800. You make profit of 6,72,800. This profit should be deferred and amortized over the entire period. Will not be recognized as an income in the books of the lessee immediately. It should be deferred and amortized over the lease period in the pattern of depreciation. So please do 6,72,800 divided by 8. 84,100. And that asset will be recorded and it will be depreciated over 8 years. 850 to 800 is the value at which it should be recorded and it should be amortized over the, it should be depreciated over the period of 8 years, 1,06,600. This is the total charge on our P&L. I think in the beginning I made a small mistake. I ended up telling that This is what is done for operating lease. For finance lease, any profit that is booked is deferred and amortized over the lease period and not recognized immediately. I hope you understood this. This is on sale and leaseback point, accounting standard 15. See, accounting, sorry, little bit frustrated here. Yeah, long day of class. Question number 15 on accounting standard 19, which is talking about leases. Let's go to question number 16, which is on accounting standard 20, which talks about EPS, earnings per share. PPS anta bartade. Should 15 he told no, 15 PPF, provident fund and 20. Sorry. Question number 16, accounting standard 20, earnings per share. Should appropriation to mandatory reserves be excluded from net profit? When we are computing EPS, we take in the numerator net profit attributable to equity shareholders divided by weighted average number of equity shares. In the numerator, when we take reserves, should it be after it? In the numerator, when we take profit, should it be after transferring to mandatory reserves? No. I agree. Reserves are not eligible for distribution as dividend. What we are trying to identify is earnings per share, not dividend per share. So the numerator profit should be taken before deducting any appropriation to any reserve, whether statutory or not statutory. Same answer will be given here in the material also. If you read, you can read this later. I will not be adding the link of this file in the description because this can be downloaded from ICA website only. Let's go to question number 17, which deals with intangible assets, something that we cannot touch but we can only feel. Swift Limited acquired patent rights to manufacture solar rooftop panels. From next time on the car they'll put solar roof. Sorry, this is not Maruti Suzuki Limited, this is Swift Limited. That's the name of the company. They bought a patent. Patent is an intangible asset. This intangible asset has to be amortized over the useful life on the pattern of utilization. The production life has been estimated to be 5 years. We'll amortize it over 5 years. What is the pattern? Cash flow expected 300, 300, 300, 50, 50. 300 plus 300 plus 300, 900 plus 150 plus 150. 1200 is the total cash flow. In that proportion, you charge. But this is the initial estimate. After third year, estimate that patent would have been estimated for the balance future of useful life of 3 years. After 3, the remaining useful life should be 2, but they're re-estimating it to be 3 and expected the cash flow after the 5th year to be 75. Let's do first. Let's do it first for the first 3 years based on the old estimate. Have a look. Based on the old estimate, first year 300, second year 300, third year 300, fourth year 150, fifth year 150. This is the original estimate. Based on this, total cash flow is 1200. Opening balance of the unamortized asset, intangible asset purchased is 600. 600 multiplied by 300 by 1200. This 600 is amortized over 5 years on the basis of this cash flow. How much is 600 into 300 by 1200? Amortization comes to 150. Closing balance is 450. Next year I'll start with 450. Amortization is again 600 by 300. Sorry, 600 into 300 divided by 1200. 150. Out of 450 opening balance, if I amortize by 150, I'll again get 300. Third year I will take 300 and I'm going to amortize it by how much? 600 multiplied by 300 divided by 1200. Same story again. 150. I will get 150. This 150 should be amortized over year 4 and year 5 as 75, 75. But before I do that, they re-estimated the cash flows. 4th year 150, 5th year 150. They're telling 6th year, the year after year 5 is to be 75. Now, there is change in accounting estimate. Initial estimate 5 years useful life. Revised estimate 6 years useful life. When you re-estimate the useful life from 5 to 6, it is change in accounting estimate to be given prospective effect and not retrospective effect. We will not change the first 3 years computation, already done. I'll take the closing value as on year 3 as the opening value for year 4, 150. This 150 will be amortized over year 4, 5, 6 in 150 plus 150 plus 75. This ratio 375 is total. So I'll do 150 into 150 by 375. 60 out of 150. If I amortize 60, I'm left with 90. Second, 5th year I'll take 90. I'll again do 150 into 150 by 375. I'll get 60. and 30 will be the closing value, and I'll do 150 into 75 by 375, which is 30, and the asset is fully amortized. Remember, useful life, pattern of cash flow expected, as well as the amortization charged in each year is accounting estimate, and such change is to be given prospective effect. That's it. Determine the amortization cost of the patent for each of the above years. Done. Next, let's go to accounting standard 27 question, which is question number 18. Briefly explain the scope and forms of joint venture. Scope of joint venture. Joint venture is an entity where two or more parties have jointly controlled it. They have more than 20%, but they don't have more than 50%. They have substantial interest, but they don't have control. And in that case, it can be jointly controlled entity, jointly controlled assets, or jointly controlled operations. Write a short summary on that. It will be done. Theory answer. It's given in the RTP only. You can read through the same thing. I can show you the answer. Yeah, jointly controlled operation, jointly controlled asset, and jointly controlled entity. Three forms of joint control. You can read through that. That's accounting standard 27 question. Next, I'll take you to question number 19, which is on impairment of assets, which is accounting standard 28. Let's begin. X Limited purchased a fixed assets 4 years ago for 150 lakhs. We've done the same question. I think similar numbers, or I think it's same numbers. 150 lakhs 4 years ago purchased, will depreciate for 4 years, we'll get the revised cost, and then we'll do impairment. Anyways, we'll do it as if we're doing it first time. 150 lakhs is the cost of the asset when we purchased 4 years ago. Depreciation is at 10%. Do 4 years depreciation. Let's start. I will record the asset carrying amount 4 years ago is how much? Original cost is 150. Depreciation at 10% for 4 years. 150 into 10% into 4 years, 60. From 150, if I deduct 60, 90. 90 is the carrying amount of the asset. At the end of 4th year, it was revalued. It has revalued the asset at 75 lakhs. So the revalued portion is 75. 90 has become 75. So 90, if it has become 75, we've done downward revaluation by 15 lakh. When we've done downward revaluation by 15 lakh, this 15 lakh is completely returned to P&L account. If they would have written upward revaluation, then they would have thought of writing it to revaluation reserve, which will be later used when we are writing off that impairment loss before charging it to PL. But here, it is already charged to P&L because this is downward revaluation. Then, see, they also told the same. Loss has been written to P&L. However, on the date of revaluation, market price is 67.5. Market price means if I sell it today, I'll get 67.5. This is basically selling price expected. From this, if I deduct the expected cost of disposal 3 lakh, I'll get net selling price. 67.5 expected selling price minus expected expense to sell 3. You do 67.5 minus 3, 64.5 is NSP. I'll write recoverable amount. It is higher of NSP and value in use. Higher of net selling price or value in use. Net selling price is 67.5 lakh minus 3 lakh, which is 64.5 lakh. Have they given value in use? What will be the treatment in respect of impairment loss on the basis of that fair value revaluation? Purpose is determined by market value. Value in use is 60, which is anyways not important because whichever is higher will become 64.5. So recoverable amount is 60 value in use or 64.5 net selling price. Whichever is high becomes 64.5. The carrying amount of the asset 75, but it can recover only 64.5. We are assuming that they have an indicator to check for impairment. That's the reason we are doing it. If there is no indicator, we would have actually not checked for any impairment. Now tell me how much is impairment loss. 75 minus 64.5, 10.5 will be deducted from the cost of the asset, and it will also be charged to profit and loss account. If there was some goodwill which is directly attributable to this, before deducting from the asset, I would have deducted 10.5 from the asset. And if there was revaluation reserve created on upward revaluation of this asset in the past, instead of charging 10.5 to P&L, I would have adjusted against that revaluation reserve portion. But anyways, goodwill is also not there. Revaluation reserve is also not there. Easy, simple question. We're done with accounting standard 28 impairment question, which is question number 19 from our material. We're now heading to question number 20, which is on accounting standard 29, which is, by the way, the last question in our material. An oil company has been contaminating land for several years. They believe that it's their father's land and they're contaminating the land from several years. It does not clean up. Clean madodilla. They don't understand Swachh Bharat Abhiyan at all because there is no legislation requiring cleanup. There is no law which says that they are supposed to clean. Like how you sharp the pencil and then put the pencil sharpening on the floor. What have they done? They've destroyed the land and they've not cleaned it at all. There is no law. There is no Yashas Act 2025 which tells that student who puts pencil sharpenings on the ground will be made to stand upside down from fourth floor, and there is no such law. But though there is no such legal obligation, you have moral obligation, you have ethical obligation to keep the class clean. You guys are not nursery kids. I'm going to say in this example, they are supposed to keep the land clean because the nature does not belong to you. The nature belongs to the future. You are just a user. You are not the owner. So they would have to make the land good and then keep it. They have a moral obligation to make it good. Yeah, I agree there is no legal obligation. But if you continue to abuse the land like this, very soon there will be a legislation and you might have to pay fine for it. I'm telling about the company. Virtually certain that the law requiring the cleanup will come. See, 31st of March 2025, company is 100% sure that people have been protesting. People have been protesting and the new law will come, which will enforce a liability on the company. So what should we do? Firstly, it was a contingent liability if you think the law will not come. Now, because there is a virtual certainty that a new law will come, you will be obligated to clean up and you might have to incur money. So because there is a present obligation, which is going to be resulting in a probable outflow, there is a virtual certainty. You would have to create provision and it is not sufficient to only show contingent liability. Is it a contingent liability? No, it is almost a provision. We have to create provision for such expense that should be incurred to clean up the land for the damage that you've done to the land because of you extracting oil over several years. That's the question on accounting standard 29, question number 20 from your RTP January 2026. All the best for your examination whenever you're writing it, Jan 26, May 26 or September 26 or onwards. But I can't give you chits in the examination. I can only pray for your success. I will definitely include you in my prayers. You please include working notes in your answers. And do let us know in the comments as to what topic is it that you're finding difficult. And is there anything that we can help you before you go for your examination? There is also a marathon revision in the same YouTube channel which you can refer for your better preparation. Wishing you all the best. Wishing you and requesting you to stay in the game. What do you say? Hey, whatever, yeah. Bye.